2 days in the span of 25 years is like a grain of sand in an hourglass. Imagine spending 25 years building a successful career only to see it crumble in just 2 days. Welcome to Do Academy. This is the story of Bill Hwang, who went from Wall Street hotshot to the man who lost 20 billion USD in an instant. Brace yourself for a tale of market plunges, forced liquidation, and crippling losses, all unfolding in a dramatic 48-hour saga. Born in South Korea in 1964, Hwang moved to the United States in 1980s. After completing his MBA at Carnegie Mellon University, he worked in sales at New York Modern Securities. In 1994, he recommended a stock to a client and brought in substantial profits. This client was none other than renowned Tiger Management founder Julian Robertson. Impressed by Hwang's performance, Robertson offered him a partnership. The good times, however, didn't last. In 2000, thanks to the Nasdaq.com crash, Tiger Management was forced to liquidate. In the following years, Robertson focused his efforts on mentoring and investing 60 up-and-coming hedge fund managers known as the Tiger Cubs. Hwang was one of them, receiving a starting capital of 23 million USD to launch his own Tiger Asia Management Fund in 2001. Leveraging the investment talent and skills he learned from Robertson, Hwang successfully expanded Tiger Asia Management's fund scale to over 5 billion USD at its peak, making it one of the largest hedge funds in Asia at the time. Over its 11-year operation, the fund achieved an annual return of 16%. However, the company was plagued by a series of scandals. Bill was accused of illegally profiting from insider information in 2008 and 2009, resulting in hefty fines from both the U.S. Securities and Exchange Commission as well as the Hong Kong Securities and Futures Commission. While the SEC fined him 44 million USD, the Hong Kong SFC banned Tiger Asia Management Fund from trading securities in Hong Kong and froze over 30 million USD in assets. This was when Hwang decided to close the fund and establish Archegos. Facing restrictions on managing client money through traditional funds, Hwang created Archegos as a family office. Essentially, these are private firms created by wealthy families to oversee their investments and financial affairs. Since the family in family office implies it primarily serves one family, it only has one client, thus requiring no registration and escaping SEC regulation. Leveraging this loophole, Hwang grew Archegos assets from 200 million USD to 20 billion USD from 2013 to 2021. How did he achieve such a feat in just 8 years? Archegos employed equity swaps, a leveraging tool to gain exposure to large stock positions with limited capital. It basically exchanged the performance of his chosen stocks with investment banks for a fee, allowing it to acquire a larger position in stocks. For instance, if Archegos wants 1 million USD worth of stocks, it only needs to provide about 200,000 USD in capital to the investment bank, which then uses its own fund to purchase 1 million USD worth of stocks in the market. According to the equity swap contract, if the stock price drops by 20%, Archegos needs to pay the bank 200,000 USD in losses. But if the stock price rises by 20%, Archegos receives corresponding profits from the bank. Using this example, this means the investment bank provides 800,000 USD for Archegos to acquire 1 million USD worth of stocks, which is 4 times the leverage. The bank in turn earns a high commission with seemingly low risk. When Archegos started, it invested heavily in Chinese companies going public. This means they paid investment banks millions in fees each year. And the banks had a safety net. If the stock prices fell, Hwang either had to put up more money or the banks could sell his other assets to cover their losses. Buying stocks through equity swaps meant nobody knew how much Huang was buying, even if he was secretly buying the most. This secrecy gave him room to take big risks, so Huang piled up his money into American and Chinese companies like Viacom, Discovery, and others. Normally, this wouldn't hurt the investment banks he borrowed money from, no matter if the stock prices went up or down. But here's the twist. Bill wasn't playing fair. He borrowed money from 6 different banks, not just one. This meant that if the stocks crashed, things could get very messy very quickly. On 22nd March 2021, American media company Viacom announced a $3 billion USD refinancing plan. It caused the stock price to take a nosedive, dropping 9% on Tuesday and a huge 23% on Wednesday. And this was one of the 8 stocks Archegos had taken a bet on with a $10 billion USD position. If the stock price kept dropping, the investment banks could sell all of Archegos' shares, wiping it out completely. The banks themselves weren't worried about Viacom's price directly, but they had a different fear. If Archegos went bankrupt, they'd be stuck holding all of the $10 billion USD of Viacom shares and would have to sell them quickly to avoid even bigger losses. This would flood the market with Viacom shares, pushing the price down even further. It'd be a messy situation for everyone, with millions of dollars potentially going up in smoke. With panic setting in, the investment banks held an emergency meeting, desperate to offload the massive positions linked to Archegos. 2 paths lay before them. First was the gentleman's approach, which was a slow and steady sell-off to minimize market impact and present a united front. The second was the less chivalrous way, a frantic all-man-for-himself individual escape. The latter solution was tempting. After all, who wouldn't want to jump ship first if others were about to dump their shares? So self-preservation won. By Thursday afternoon, Morgan Stanley broke ranks, quietly offloading $5 billion USD in Archegos-linked stocks at a discount. On Friday's opening bell, Goldman Sachs followed suit, unleashing a $19 billion USD fire sale, mostly through large anonymous block trades. The house of cards was collapsing, and the market braced for impact. Goldman Sachs emerged relatively unscathed, but the others weren't so lucky. Morgan Stanley took a $911 million USD hit, while Nomura Securities lost $2 billion USD and Credit Suisse $4.7 billion USD. The market itself resembled a war zone. Viacom plummeted 53.4%, Discovery nosedived 46.3%, and Baidu tanked 38.7%, all within a single week. This wasn't just a blow-up, it was an earthquake. Archegos, of course, crumbled. Huang, once heralded as a financial prodigy, became the poster boy for this century's biggest blow-up and faced 11 criminal charges. But the story goes deeper than one man's folly. It exposed the faulty lines beneath the seemingly smooth surface of Wall Street. Lax regulation, cutthroat competition between powerful investment banks, and hidden battles for profit fueled by complex financial instruments. The lesson is stark. High leverage is a double-edged sword. It can amplify gains in good times like Archegos' experience, but without proper risk management, it can turn into a weapon of self-destruction, leading to devastating losses. Leverage itself isn't the enemy. It's a tool, and like any tool, its fate rests in the hands of the user. There's a fine line between calculated risk-taking and reckless gambling in the financial world. So what do you think? Has Bill Huang's story changed your own perspective on leverage and investment strategies? Share your thoughts in the comment section below. Be sure to like, share, and follow Do Academy for more actionable investment insights.